welcome back, guys. So, in this particular episode, what we will be discussing about is Aspire. Okay, so Aspire is a public limited company which operates many of its activities overseas. Okay, the directors have asked for advice on correct accounting treatment of several aspects of Aspire's overseas operations. Aspire has a financial statement year end of 30 April 20x4, right? So Aspire's functional currency is the dollar. The average currency exchange rate for the year is not materially different from the actual rate. Okay. So $1 is equals to 5 dinar. Okay. 5 dinar is equals to $1. Okay. So it's a public limited company, operates many of its overseas, right? And then I've asked for advice on correct accounting of several aspects of overseas operations. And then year end is this functional currency is dollar, okay? Has not materially been different from the actual rate. Okay, that's what we need. I would like to advise on how to determine functional currency. So Aspire has created a new subsidiary which is incorporated in the same country as Aspire. The subsidiary has issued 2 million dinars of equity capital to Aspire, okay, which paid for the shares in dinars. The subsidiary has also raised 100,000 dinars of equity capital from external sources and has deposited the whole capital with a bank in overseas country whose currency is the dinar. Okay, the capital is to be invested in dinar denominated bonds. The subsidiary has a small number of staffs and its operating expenses, which are low, are incurred in dollars. Okay, so that is inconclusive, right? So primary factors and then the profit are under control of Aspire. Any income from the investment is either passed on to Aspire in form of dividends or reinvested under instruction from Aspire. Subsidiary does not make any decision as to where to place the investment. Okay, so no autonomy as well, right? So So we will need to consider that as well. Autonomy and then the level of transaction between that, right? So first of all, what do we do is that let's write down functional currency. Okay, functional currency. IAS 21. The effects of changes in changes in foreign exchange rates defines functional currency as the currency of the primary economic defines functional currency as the currency of the primary economic environment in which the entity operates, and then primary indicators or primary factors, you could say primary indicators will be an entity whose management considers the following primary indicators in determining its functional currency. First thing being the currency which influences which mainly influences the sales price for goods and services. Second thing being the competitive forces or the currency of country whose competitive forces and regulations affect the sales price of goods and services, right? You could say which mainly influences or anything, okay? And the third being the cost, right? The currency in which uh, mm, the currency which mainly influences material, labor, and other costs of providing goods and services. And secondary indicators are, so in case of secondary indicators, are number one will be the currency in which funds from financing are generated. Second factor is the currency in which operating revenue in which operating revenue are retained, okay? And additional factors should be also taken into consideration if the functional currency can't be defined from above, and they are: first is autonomy, level of autonomy, the autonomy of a foreign FOREIG and foreign operation from the reporting entity. Second is level of transaction between the whether the foreign operation generates sufficient cash flow to meet its cash needs, okay? And the last thing is whether cash flow directly affect those of the reporting entity. Okay. So what we do, application to scenario, right? In case of Aspire, operating costs incurred operating costs are, so what has happened, operating costs are incurred in dollars, right? Whereas the funds are raised in thing, right? So that is not conclusive, both of them, so it contradicts one another, right? Dollar, however, okay, so it talks about that as well, right? However, it is not material, right? Which are low, however, it is, or they are not material to any decision as to the functional currency, so other factors should be taken into consideration. The subsidiary has issued $2 million of equity capital, 2 million dinar of equity capital to Aspire, and has also raised, what did it raise? Another, how much? Raised 100,000 dinars of equity capital from external sources. 100,000 dinar of equity capital from external sources. So it is likely that dinar is the currency in which operating in which activities are conducted, and then after that, so what is however, okay, so what else is there? So profits are under control of Aspire. Any income is passed on to Aspire. So it does not make any decision where to place the investments or no. However, the investment decisions are made by Aspire, which suggests that the subsidiary has has little autonomy. First thing is checked off, right? And after that, and then remittance, right? The income from investment is remitted to Aspire or reinvested as per instruction from Aspire. And the subsidiary has a minimal number of staff and does not have any independent management. It would therefore seem that the subsidiary is simply a vehicle for the parent entity to invest in dinar-related investments. Therefore, the functional currency is therefore it seems the subsidiary is an extension of parent and so its functional currency would be same as parent, that is dollar. Okay, so what we talked about next, what we need to talk about next is that Aspire took out a foreign currency loan of 5 million dinar at a fixed interest rate of 8%. Okay, on 1st May 2003, the exchange rates are given this date, and then the effective interest on the loan is 8%. Annual interest payment commencement on this date. Okay, so 5 million at 8%. The loan will be repaid on 30th April 20x5, right? So that means 30 April 20x4. 30 April 2005 after 2 years, right? It requires an half to account for the loan and interest. Okay, so the loan is non-financial. Financial monetary item. So that means it will be translated at the closing date, and then after that, any gains or losses will be taken to OCI, right? So since it is a subsidiary and thing, so it's not individual, right? Okay, so overseas loan, right? Overseas loan. financial liability because it contains obligation to transfer cash. As per IFRS 9, it should be measured at amortized cost. As there is no indication of selling to be classified as fair value through OCI, right? In a contract, the intention is to this is a debt. Okay, so it should be measured at amortized cost, and then after that, liabilities at amortized cost is recognized initially as a value less cost. Transaction cost, the finance cost is calculated using effective interest rate L, and then after that, the loan is denominated in foreign currency and so must be translated to presentational currency as per IAS 21. Effects of changes in foreign exchange rates. And then what we can also say is that any gains or losses so what will happen is that the overseas loan should be translated okay, it's Aspire itself, right? Which has taken out a loan. Okay, the overseas loan should be translated using spot rate. The finance cost is translated using average rate, because it is close to actual rate. The cash payment should be translated at spot rate which is at the reporting date. Loan is a monetary item. Monetary liabilities, so is retranslated at the reporting date using the closing rate. Any exchange gain or loss is recognized in profit or loss. Okay, so this is not a subsidiary, it's a parent itself. Okay, okay, so what we will do is that let's use Google Sheets so that it's easier. Okay, so let's use our standard for performer, which is particulars, right? And then opening balance, and then what else? Finance cost. And then what have we done? Payment has been made, right? And then translation gain or loss, right? And then after that, closing balance. So what is this? This is in dinar, this is in exchange, this is in dollar, right? So what was our figure? The opening balance was, how much loan did we take? 5 million, right? Okay, 5 million dinar. Exchange rate is at the beginning 5. Okay, 5, right? So this will be this figure divided by this figure, right? And then finance cost will be 8%, right? This into 8% is, or what we could do, 0.08, right? And then finance cost will be average, right? So average is 5.6, and then closing rate is 6, right? 5.6, and then payment will be in 6, closing rate will be in 6. So payment, how much did we make payment for? We made a payment for the interest amount, right? For the same amount. Okay, so our closing balance will be sum of all this. Okay, so this will be best and best. So what will be the sum? Let's add all this thing up. This 3 will be 1 point something, right? So this minus this. So that's our change gain, okay? Since it is loan, so it will be like this. Okay. So we can basically copy and paste this thing as well. Copy, paste, linked, not B. Control Z. The loan will be initially recorded at $1 million. The finance cost recorded in SOPL will be $0.071 million, and the cash payment will be $0.067 million. Foreign exchange gain $0.171 million is recorded in SOPL, and the liability would have a carrying amount of $0.83 million. 3 million, right? 33 million. So once that's done, so I guess we can move on to the next question. So what is the next question about? Okay, so now this is done, we can close this off. So the directors of Aspire wish to report an additional performance measures to its stakeholders. APM will be calculated by taking profit before interest and tax. Okay, profit from operations, which they mean. Wish to report APMs to its stakeholders. Will be eliminating foreign exchange gain or losses. APM will be displayed on the face of SOPL below profit after tax, and the explanation of how it is derived will be provided in disclosure note. After adjustment for the issues in Part A, Aspire will report a loss before finance cost and tax of $2 million. Total foreign currency losses reported in profit or loss amounts to $3 million. The majority of the exchange loss arise in settlement and retranslation of receivables arising from sales to overseas customers. Okay, so on settlement and retranslation of receivables, Aspire offers most customers credit facility of 60 days. Discuss the potential advantages and disadvantages of APMs proposed by directors of Aspire. Professional marks will be awarded for clarity and quality. Okay, so APMs, right? APMs advantages and disadvantages. APM Advantages, disadvantages. How will it be misleading? So we'll talk about that as well. So foreign exchange gains and losses are volatile. Eliminating these may give rise to the stakeholders better understanding of Aspire's underlying performance. This is particularly true if the foreign exchange gain or losses or gains and losses are likely to be reversed before that transaction is settled. Right? Eliminating foreign exchange gains and losses may make Aspire's performance more comparable with entities that do not translate or that do not trade so heavily overseas. Okay. So disadvantages would seem that Aspire is trying to disguise its weak performance in current year. Adding back the foreign exchange process turns the how much million is it? 2 million, right? Okay, after adjustment in part A as well. So before finance cost and taxes, 2 million. Total foreign currency losses reported in is that right? So turns the 2 million operating losses of Aspire into $1 million profit. Aspire's exposure to foreign exchange losses is not wholly outside of management control. Management could, for instance, enter into hedging arrangements to reduce their foreign currency risk exposure, eliminating foreign exchange losses may disguise management activity or management inactivity with regards to foreign exchange risk management, because they are not doing it properly, right? And that's why there is a huge thingy. Whilst foreign exchange movements on long-term items such as loans are likely to be reversed, okay, reverse over time. This is not the case with short-term items of foreign exchange lost on a relatively short-term receivables means that the entity has received or will receive less money from their customers than the value at which the sale was originally recorded, right? This is a real loss to Aspire that will affect their cash flows and liquidity. Eliminating these foreign exchange losses is therefore not a faithful representation of economic performance of Aspire. It would seem that Aspire intends to disclose its APM prominently. This might users of financial statements to wrongly believe that is a subtotal identified within IFRS and IS standards, which could have a material and potentially misleading impact on current and potential investors. Since they are presenting it in thingy as well, right, in the face of the statement. So yeah, basically I think we've covered everything. So if you have any confusions until now, please do comment down below. I will definitely answer it for you. So since this loan is only for overseas subsidiary, okay, so this is the treatment for individual financial statement. So since it was not the overseas subsidiary which had taken the loan, it was Aspire which had taken the loan. That's why the treatment is done like this, okay. So yeah, that's it pretty much, guys. So if you have any questions until now, please do comment down below. I'll definitely be looking forward for answering them. Until next time, bye bye.